Hi, my name's Tim Raes, and I'm the founder and managing director of Aussie Expat Home Loans, the most trusted and reliable mortgage brokerage for expat Australians. As expats, we exist within a very unique community of people that get to live and work overseas. But as part of that experience, we have a lot of unique needs that are very different to when we live back home. I'm very privileged to be able to work with some of the best in the business when it comes to experts that cater to expats. And so I wanted to be able to bring some of that knowledge to you through a new educational series that we're running. The topic that I get the most queries about from clients, apart from mortgage broking, is tax. And so for our first episode, I'm very privileged to be able to have Tristan Perry, Managing Director of RP Private in Singapore, who runs the tax and accounting division. The first topic in our series is capital gains tax. I get a lot of tax queries. The number one query I get is around capital gains and how they're treated as an overseas resident compared to when you live in Australia. Tristan, capital gains tax. I know it's the number one tax query I get from clients. I'm almost certain it's the number one query you get as well.
Definitely something I talk about every day of the week.
Yes. So very excited to have you here to help break it down for us.
Thank you.
Probably let's start from the top and get some context. What are the biggest differences between being a non-resident for capital gains versus being a resident for capital gains?
So really good question. So working through the list of the key kind of differences is the first one is the 50% capital gains tax discount. Mm-hmm. So this is a concession that Australian residents receive when they sell a capital asset like a property, where effectively you cut the gain in half. Non-residents miss out on that, and that was a change that came in on the 8th of May 2012. So largely speaking, for a expat who has purchased and sold a property whilst they're being offshore, they miss out on the 50% capital gains tax discount altogether. But for someone who has owned a property previously or has purchased a property offshore and brought it back home, you would qualify for a partial 50% capital gains tax discount on a straight line method.
So basically, while you're offshore, the government wants as much money as they can from you.
Exactly.
If you sell a property.
Exactly. And it gets a little bit more tricky if you've owned the property on the date of the change on the 8th of May 2012. We need to get a valuation. But long story short is, unfortunately, you do miss out on that major concession, which is a big one for a lot of Australian residents.
Definitely. So probably the biggest myth that I hear from a lot of clients is that if they sell a house that they lived in previously when they're non-residents, that they still qualify for the principal place of residence discount. But that's, you and I know that's not correct.
Unfortunately so. Yeah, so let's talk about the principal place of residence exemption and what it is and what the major change is. So the principal place of residence exemption allows you to sell a property that you once upon a time lived in it, capital gains tax free. Now, the major change that happens in relation to this is they remove the ability to sell it whilst you're a non-resident of Australia for tax purposes. So with a few carve-outs for exceptional circumstances. So one is divorce, and unfortunately I've had a few clients that have had to rely on that. And the other are pretty horrible, as in it's death or terminal illness, and thank goodness I haven't had any clients that had to rely on that so far. So so basically what the concession says is, it says first you need to establish the property as your principal place of residence, i.e. living in Australia. Then you move offshore. You've got the ability to rent it for up to 6 years. And if you return to the property within that 6-year period and reoccupy it, you'll reset the clock. So that the property is effectively continues to be your principal place of residence and capital gains tax free when you sell it. If you stay beyond the 6-year period, you get a pro rata allocation of time, basically on a straight line method. Mm-hmm.
So basically, you've lived in the property, then you move overseas. As if you move back within the first 6 years, you still qualify for the full exemption.
Correct.
Again. If you stay longer than 6 years, then you'll have some exemption, but it'll be allocated against the time that you were away overseas.
Yeah, exactly. So in a sort of a simple situation where we have a client who first lived in a typical expat family, let's say, lived in a property in Australia, bought it, moved into it straight away, was their family home for a period of time, then they got the expat assignment, so they came offshore, and let's say they lived in the property, or they're offshore for 10 years, and then they returned to Australia and reoccupied the property, and let's say they lived in it for another 10 years and sold it. So in that sort of situation, they'd still qualify for the 6-year exemption period. However, they would have an additional 3 years above additional 4 years above that 6-year period, where it would be taxable, subject to tax, then when they return back into the property to re-establish it, they start accruing the principal place of residence exemption time again. So in that sort of situation, we'd need evaluation when they first started renting the property.
Okay. So a lot of people don't realise that they need to get valuations at certain points in time as well, and I think it's a really important point that they need to be getting tax advice as soon as they move offshore for some of this as well, because a lot of people wait until they go back and then it's too late by the time you go back.
Correct,
So,
exactly, yeah. Once you step back across the line, there's unfortunately the time machine isn't as useful as we hope so.
Yes. I know we've talked a lot about the principal place of residence exemption. Another very common scenario that I have for clients are obviously they move offshore, they're starting to earn more income, they're starting to be able to have more they're starting to have more available cash to be able to invest in property into Australia. So how does the capital gains discount work for someone that buys an investment property offshore, then eventually moves home and sells the property when they move home? Will they ever qualify for the 50% exemption when they're back in Australia? And then if so, I know it's probably a complex formula, but what is a simple way to think about how long it would take for them to qualify for that exemption?
Let's talk about a really simple scenario. So you're offshore, you buy a pure investment property, so there's one that you never plan to live in it.
Yes.
And you own it for 5 years. So you've got 5 years, you bought it, you've got a home loan against it, you've got some depreciation deductions as well, you're collecting some tax losses or tax credits during your time offshore. You then move back to Australia and let's say move into a different property. This property continues to be an investment property for you. You continue to rent it for another 5 years, and then you sell it. So your total ownership time is 10 years. So in that situation, the tax office just looks at it and they say, okay, the taxpayer has owned the property for 10 years. Half the time they're a non-resident, so 5 years. Half the time they're a resident. So you'll qualify for a 25% capital gains tax discount eventually when you sell it.
So it's prorated based on the amount of time that you're living in Australia versus the total time you've owned the property.
Correct, yeah, and that's a situation that you do not need a valuation for.
Okay, good to know. Probably the last scenario that we get is someone buys a property when they're offshore, but it's going to be their future home when they come back. I see a lot of that. It's the 2 to 4 year plan, and then they want to go home and know that they have something to move back into.
Yep.
Whether we actually go home after 2 to 4 years is...
I think Tim, you'll recall
varies a lot, yes.
You also helped me with that strategy as well.
Yes.
Yes.
So if you've lived overseas, bought this property, then you move into it, at what point is the property ever 100% capital gains free, or is there always a portion of time that there will be some tax?
Yeah, no, that is a really good question, because it is a myth that's out there. A lot of people believe that they can move back and live in the property for a period of time and it will eventually be capital gains tax free. Sadly, that's not the case. So in that sort of situation, I can even talk about my own personal circumstances. So myself and my wife, we went out and found a lovely house in Melbourne, and you helped us with the loan. Thank you very much for that. Currently, that's an investment property because I'm living offshore as a non-resident, and that will remain basically an investment property until such time that me and the family move back into that property to establish it as our principal place of residence. Now, let's talk about the same sort of 10-year scenario. So let's pretend that we've owned it for 5 years whilst we've been a non-resident, and then we've moved back into it for 5 years and then sold it. So we just decided it was too big or not right for us or whatever, and we decided we wanted to sell the property 5 years after returning to Australia. So in that sort of situation, we'd have 5 years as an investment property, then 5 years as a principal place of residence. So eventually in 10 years' time when we sell it, half of that property is going to be exempt for capital gains tax. And then to add another complicating factor onto it without getting too deep into the details, that property would also qualify for a partial 50% capital gains tax discount on the basis that we've been living in Australia for 5 out of the 10 years.
I think the important thing to remember is while you're offshore, the government's going to come after as much cash as they can.
Exactly.
But when you go home, you do start requalifying for the same investment rules and PPR rules that people that have lived in Australia qualify for.
Correct.
But there always is going to be some period of time that you're going to have some tax penalty for living overseas.
Basically, yeah. Well said. But there is also there is a silver lining, Tim. Always is.
Yes.
So in this sort of situation, we have, for example, in my situation, myself and my wife, we've collected 5 years worth of tax credits, which is good. So because we rented out, we're renting out our property at the moment. In this situation, we hypothetically rented it out for 5 years.
Yes.
We've got 5 years worth of tax losses that we've accumulated during that period of time. That when we do return to Australia and start living and working there, that we've got some tax losses that will help reduce our tax taxable income and save a bit of tax back in Australia.
For sure. And you've also benefited from the fact that the market has continued to increase over that 5 years.
Exactly. We're buying it at today's prices rather than tomorrow's.
Yes, yeah. And having security for your family is also
exactly
the main reason I see clients buy.
Exactly.
Go back. So probably one last scenario to talk about is the actual non-resident tax rates that you'll be calculated on if you do sell the property as well. Because the tax rates when you're a non-resident are different to back home. There's no such thing as a tax-free threshold.
Yep. Well,
how does it actually get calculated?
Well said, Tim. So the first factor we do is we confirm that the client is a non-resident of Australia for tax purposes, which if you're an expat where you're living and working offshore, you've got more than a 2-year intention, your family's with you and you've got nowhere to live in Australia, there's a good chance you're a non-resident of Australia for tax purposes. This is a tricky area, so you should take advice for that just to confirm that is the case. Yes. But in that situation, so a non-resident tax rates in Australia basically have no tax-free threshold. Straight away you're into 30% for every dollar that you earn, and then you slowly from 135,000 you tick up to 37 cents, and then when you're up at 190,000 it's up to 45 cents in the dollar. No Medicare levy. So in the situation where you buy and sell an investment property when you're offshore, so one is you'd miss out on the 50% capital gains tax discount. 2, it's an investment property, so there'd be no principal place of residence exemption. So basically you're left with basically the pure profit gets taxed at those non-resident tax rates. So when a lot of people say to me, what is the tax rate for capital gains? It's marginal rates, just depending on whether you're a resident or you're not.
Yeah. And I always, for any client that's planning to sell when offshore, it's so important that they get advice for it, because as we talked about, there's multiple scenarios for how capital gains can be calculated on any sale that you have, and the calculation can be complicated.
It can, and there's other factors you need to consider, such as the foreign resident withholding tax as well, that you'll be, which is a temporary withholding tax. It's not an additional tax, but it's important for cash flow planning.
Yeah, to be covered in another episode.
Exactly.
So I guess just to recap a couple of the key points, like we talked about, while you're offshore, there's no capital gains discount for you. So it's just something to be aware of, that you won't qualify. Just because you lived in the house before but move offshore and sell it, it likely won't qualify for any principal place of residence discount.
Yep.
If you go home and sell it, it can qualify, but there's a couple of criteria people need to be aware of. And then yes, if you buy an investment property when offshore and go back home, it will eventually have some discount applied to it, but the time period matters. So in every scenario, someone needs to get advice from the best in the business.
Oh, you're very kind. Well summarised. Thank you, Tim.
Thanks so much, Tristan.